to that. And let me welcome Matt Orton, Chief Market Strategist at Raymond James Investment Management, joining us. Hi, Matt. Thank you so much for your time. And firstly, with respect to the PPI numbers, it was cooler than expected, easing the inflation concerns. So why don't you help us with your take on the numbers and reading so far? And today, since the CPI will be slated, what are your hopes on that?
Good morning. It's always great to join. And I think the inflation data is continuing to come in, showing that perhaps the balance of risks is shifting a little bit more towards unemployment than on the inflationary front. I think the challenge that Powell has and the challenge that we're going to see play out tomorrow, because we will get an updated summary of economic projections, which basically is the forecast for all of the different Fed officials in terms of where they see the rate cutting path going and how they think about the economy, is really this idea of how much might still be needing to come into the market, come into inflation expectations with respect to tariffs. Because one of the items we saw from PPI, while it was better than expected, we're seeing less of an ability of companies to push through price increases to consumers. So does that mean they eventually take a hit with respect to margins that remain at or near record highs? Or do they start to pass along some of those price increases to consumers, which might keep inflation a little bit more stickier than some of the data is showing right now? So I think a rate cut in September is pretty much a lock at this point. There's some talk of 50 basis points instead of 25 basis points. I'm very much in the camp of a 25 basis point cut. But again, we should be following how many dissents there are to the 25 in favor of perhaps a 50. And that'll give us a good sense of perhaps what the rate cutting path might look like for the rest of the year, where there's still a disconnect between what the Fed guidance is and what the market is aggressively pricing in.
And that is the point, right, Matt? Whether or not a 25 bips rate cut, which seems to be pretty much consensus as of now, is it already in the price or not?
Yeah, Aisha, that's a really good point. And I think it's more than in the price at this point. The market's had a great run. It's been fueled by incredible earnings. We just got more examples of great earnings from AI. And I've been very adamant in saying that AI is not at all in a bubble. And I think the earnings we saw from Oracle, that we saw from Broadcom last week, all of that confirms this. But I think the market might be getting a little bit ahead of itself with respect to the positive impact that rate cuts might have and the ability to sustain a more aggressive rate cutting path going forward. So I'm more in the camp of actually selling the news. Once we see, I kind of think Powell's going to have more of a hawkish cut when we get into September. And so I would be looking to maybe have some dry powder ready to put to work if we do see a sell-off, and perhaps look to continue diversifying into areas that I've liked for a while, like gold or gold miners, that can provide a ballast to your portfolios if we do run into a little bit of a soft patch. But I remain very optimistic on where the market goes heading into the end of the year, because earnings are what matter, and earnings remain very, very strong, irrespective of what the Fed does, at least in the near term.
All right, but Matt, what we are getting to see is that a renewed interest in the tech-heavy counters. It's not just the Nasdaq where the record run continues, but one of the key stocks, that is Oracle, the stock surged almost 36% after a strong AI and the cloud business forecast. So, Matt, good to believe that there's indeed a renewed interest in the tech-heavy counters. Some of the counters with respect to the AI business, they can do well in the near term at least.
Oh, they absolutely can. And Shrishti, I think when you look at the success of mega cap technology, it's continued to do well. I think it's sucked away some of the rotation trade that we've started to see playing out over the past few weeks. But what's interesting is you're seeing a broadening of maybe what's considered mega cap tech. At the end of the day, though, what I remind our clients is that there's a lot of different ways you can play artificial intelligence. It doesn't just have to be in the hyperscalers, in the cloud providers, which you still need to own in a portfolio. But you've seen a lot of success downstream over the past 2 weeks to your data center providers, companies that construct data centers, the companies that are providing all of the equipment used to build out those data centers, the cooling system. So there's an entire ecosystem that supports the large technology trade and the AI build out. And I think it's encouraging that the earnings we've had over the past 2 weeks have reminded investors of those opportunities. I would also remind clients, though, that there's a lot more happening, more broadly speaking. There's a lot happening around the world. You look at emerging markets that I think provide another offset to perhaps overweight risk in the U.S. And emerging markets, broadly speaking, have been doing very well. Brazil's sitting at multi-year highs. We're seeing China and especially Chinese internet giant semiconductor companies doing very well. And even India is finally showing some signs of life that I think are very encouraging to hopefully keep long-term investors involved. And show that there's still legs to this market. It might just take a little bit longer to play out.
Yeah, absolutely. A sheer amount of resilience here in India as well. But Matt, always good chatting with you. Thank you so much.
Thank you.
Well, talking about what was happening on the NASDAQ overnight and the Oracle earnings, I mean, look at that.